Welcome back to the platform for investor education. Today we shall talk about the secondary market. This refers to the trading of securities after their IPO or initial public offering and their subsequent listing on an exchange. But first, it's useful to start with a little bit of history and see how it rhymes. We can go back in time to the formation of the first such exchange to Belgium in the 16th century. It started by trading debt securities of moneylenders, businessmen, and governments. They were primarily motivated by the perceived riskiness or chance of default of one high-interest loan over another. There were no stocks to trade until the formation of the East India Companies. The Dutch, the British, and the French had investors who at the time began to put up money to stake shippers journeying to the Far East in exchange for a part of the proceeds from a successful voyage. Did you ever think that Vasco da Gama had to raise money? Anyway, risk in those days and times meant mostly bad weather, navigation, piracy. Gradually, these investors started diversifying across multiple voyages rather than a single one. Thus were the first joint stock companies formed. As the notion of spreading risk and receiving rewards for it began to take hold, other businessmen wanting to raise funds for other projects approached groups of moneyed individuals with a willingness to accept such risks. News about the success or failure of each of these new ventures was then sought out, and those early investors would collect together and trade in groups. In fact, the New York Stock Exchange was started in the 17th century by a group of such individuals, now we know them as brokers, underneath a buttonwood tree. Of course, there were speculative excesses back then. You may have read of the South Sea bubble. In fact, the tulip bubble of the 17th century reminds me of what is happening today with cryptocurrencies. Now that this is getting familiar, let's look at how the modern stock exchanges operate. Today, there are over 500,000 securities that trade in many exchanges around the world, 24/7. Trading volumes are exploding, trading costs shrinking. Regulators are continuously attempting to define standards, monitor practices, protect investors. Exchanges continuously evolve trading systems, design safeguards, and offer a range of choices to investors attempting to buy and sell securities. So let's talk about that process next. So think about a moment just before a stock exchange opens for trading. There are people willing to sell securities, others are willing to buy them. Each have different reasons. Some are managing inventory, some are reacting to news, others are simply facilitating trading activity. Let us start with one such facilitator, known often as a market maker, who has posted an intention to buy up to 500 shares of Lupin Labs at 755 and a simultaneous intention to sell up to 400 shares of 757. We have mentioned this before. 755 is the bid price, 757 the ask price. The number of shares we mentioned is known as the depth. Together, these quantities constitute a quote for Lupin at that moment in time just before the market opened. As long as the market maker can buy at 755 and sell at 757, he or she is quite happy. We had referred to this too earlier as the bid-ask spread, and it tends to be much higher than 2 rupees for many illiquid stocks in India. These market makers are not investors or even traders. They just make a market in Lupin or other stocks. There may be many market makers for one stock, each submitting a different quotation. Figure 1 below shows you the quotations for Lupin on a random day, and you can see a different range of bid and ask prices in that figure. In India, many of us can be market makers too. The best pair, the highest bid and the lowest ask, is sometimes known as the inside quote, which is where obviously traders would like to transact. So suppose now that as the market opens, an eager buyer of Lupin places an order to buy 300 shares at the market. This is known as a market order. This is the first transaction of the day at rupees 577, and the ticker tape will show that price, and the buyer will eventually get his 300 shares after settlement. Immediately though, think about this, the quotation will jump, will it not? And the next trader will come in, perhaps with a buy order or a sell order, and the market keeps moving. Quotations are constantly changing, prices are constantly being agreed upon. There are other types of orders. Let's talk about limit orders next. The trader in the previous story who was eager to buy Lupin agreed to whatever price the market maker was offering, 757 at the time. That was a market order. Exchanges also permit you to specify a price along with your order. Known as a limit order, this applies to a trader who wasn't so eager and may have chosen a specific price of 750 to buy Lupin instead of accepting the market price of 757. This is a limit order at a price of 750. It will be time-stamped and sit on the books until that specific price is reached. Looking at it from a broader term perspective, limit orders to purchase below the current market price are an indication of demand, and limit orders to sell above the current market price an indication of supply. India, in fact, was among the first exchanges to pioneer this limit order book being open, where the demand and supply for each stock in the marketplace was visible to traders. What do you think happened next? People started playing games with the orders themselves, putting them in and pulling them out just to create an illusion of demand and supply. But that is beyond our scope for now. Let's look at another type of order, a stop order. Stop orders are similar to price limit orders in that the price is mentioned on the order form, but it only serves as a trigger. Once that stop price is hit, your order converts to a market order and is executed at the next available price, which may be better or worse. For example, if you had a stop order to buy Lupin at 753, once that price is hit, your buy order may be executed above it or below it. You get close to the order price, but not exactly that order price as you would in a limit order. Why is this even important? Think about a situation where time might be more important than price. You've already bought or own some stock in Lupin, and you want to protect against possible losses. You may set a stop order a few points below the current market price, which represents about the maximum loss you're willing to accept before you exit that losing trade. You just want out. You don't care about a few paisa here or there. That's a way in which stop orders can work for you. There are many other types of orders that you can place in these markets. There are also other ways to borrow money to trade, to bet on downward moves rather than simply buying stocks and hoping for upward ones. I hope the topics in this and other modules are motivating you to get started on this journey. And as always, come back for more.